So Deanna said that she had $1,800. Whoops. I think someone has their mic on. They're a little bit staticky. I can't see who has mics on. Okay. So she had $1,800 of supplies. Now she went out and she counted and she only has $800 left. So how much did she use? She used up 1,000, exactly. So that's the number that we need to use. She used up $1,000 worth of supplies. Wait a minute. Yes, okay. So when you're looking at this one, then she's going to say supplies expense. She used up and credit supplies. Now, supplies is one of those you do have to keep your eyes on because this one was worded that she had $1,800 of supplies on hand, and at the end she found $800 left. It could also be worded where it could say, when counting, she found she used 1,000. So they could change that wording on you and actually give you this number. So you got to make sure you read it. Right? This right here, and this probably took you guys longer, I apologize. You do not have to go through and do that every time. So I'm sure that, I apologize. That if you were looking at trying to do that, I'm sure that definitely took you more effort. All right, the next one, Deanna paid for $12,000 for 6 months of rent on November 1st. At December 31st, year one, some rent had expired, 2 months. So she paid for $12,000 of rent. And how long was that rent good for?
6 months.
6 months. So the first thing you got to figure out is how much a month is. So it's $2,000 a month. And how many months has gone by? 2. All right. So she spent $4,000 on rent. So we put $4,000 here. And then what would be my debit and credit?
Rent expense and paid rent.
Yep, rent expense and prepaid rent. Now, if you would have tried to fill this out down below, what you would have had is here, assets would have been going down by $4,000 because we would have decreased rent, prepaid rent, and over here, you would have been debiting an expense. So that's what that would have looked like. All right, now we have another one. Deanna paid $6,000 for insurance for 1 year. So now we got to figure out what that's going to be per month. So 12, divide that by 12 means that it is $500 a month. So how many months have gone by? It's now December 31st. So how much do we put under here? How much has she used up?
3,000.
Okay. And I'm so glad you said that because I'm not in person and I don't have my camera on for you guys, but you need to start learning how to count on your fingers for this. Because if you count June 1st to December 31st, how many months do you get? 7. 3,500.
Oh, okay.
But let me tell you what, every single class, every single semester, I can't tell you how many people doing the same problem will say 3,000. So you won't, the people that say that, do not make that mistake again. All right?
Big mistake.
Yeah, but you won't do it again. If you make it on this problem, you don't do it again because number one, you will count on your fingers, okay? And it's June and July mess everybody up. June 1st, June 30th, July 1st, and July 31st look the same to everybody. And everybody says 6 months. Every time. July 31st, people say 6 months too. The other ones that sometime you have trouble with are April 1st, April 30th, those, and then October and November throw people off. So make sure you just count the months. Don't just say 6 months, 9 months, 4 months. Count the months, make sure you get it right. Because I can guarantee you in a multiple choice question, you're going to see 3,000 right there. Okay? All right, and so what are we going to debit and credit?
Insurance expense and prepaid insurance.
Yep, you got it. Okay, we got that. I'm going to go ahead to the next page then. All right. So we're going to scroll down, go to, come on, let me go. Okay, there we go. Go to D. Oops. All right, so D says that the company had acquired $40,000 of equipment. The depreciation was calculated to be $2,000. So, do we know what we do here? It's pretty simple at this stage. This was one of the ones that I wrote earlier, and we didn't talk a lot about it. Depreciation will be depreciation expense and accumulated depreciation. Yep. Anytime you see depreciation right now, you do not have to do anything with the number. It's just depreciation expense, which goes here. And then accumulated depreciation is actually a contra asset, and it carries a credit balance. It's a contra asset. All right, the next one says on December 1st, you sold $500 of gift cards for decorating services. The accountant at the end of the month revealed that you had $400 that were redeemed, but you had not yet done anything in the books. So you had $400 of redeemed gift cards. So what did that mean happened with those gift cards? You sold 500, so this was our journal entry we did at the beginning, 500, and deferred revenue for 500. Now they redeemed 400. What are we going to do? What happens when you redeem a gift card? You use it. I used the gift card. So I'm going to debit deferred revenue and credit revenue.
Is that, which one is that? Is that service or sales?
Yep, service revenue, yep. So before it was cash and deferred revenue because I didn't do the work or whatever it was that was in the gift cards. Now, when they went and counted, 400 was redeemed, meaning we did the work, so we have to take it out of deferred revenue and put it into revenue. All right, this next one was hard. Someone could have yelled at me. I forgot this was in there. You need to know this formula. Interest equals principal times rate times time. And so every semester I forget that this is in there until it shows up, and then I have to remind myself. So for some reason it stopped writing, but it will show up in a second. So interest equals principal times rate times time. Time is always expressed over 12 for months, okay? So you invested in a short-term loan for $20,000. You yield 12% interest. That's your rate. So principal times rate. Okay, interest of 1 year. Now, every loan is APR, which is your interest, and APR stands for annual percentage rate. So we got to take interest is going to be over 12. And when did we start this? We started it June 30th. So that actually is 6 months to the end of the year. So if you take 20,000 times 12% times 6/12, you get 1,200. I almost wrote 2,400. 1,200. And my little thing I didn't get rid of there. So now this is we invested, so they're going to pay me. They're going to pay us. So what would be the journal entry to record the interest that they're going to pay us? They owe us money. Interest something, yep. Interest. Yep. Interest receivable and interest revenue. It's either going to be interest expense or interest revenue. Interest expense is when we incurred it because of a payable that we owe, or interest revenue is when we earned it. And we earned 12% interest on a short-term investment. Okay, so this formula right here you're going to need to know. We're going to use it several times. Always over 12. Principal times rate times time. 20 times 12 times 6/12. They owe us $1,200 and it's an interest receivable. I'm guessing that was one of the ones we had questions on. Okay. I'll go on to the next one. Are we good? Okay.
Yes.
Kind of takes me page down. All right, and then we got, I'm going to move it up a little bit, but you guys have it. All right, so, and then on the next one, we have it again. This time we have a $30,000 note. So again, interest equals principal times rate times time. We have a $30,000 note times 10%. You got 1,500? So
Yep.
how did you come up with that?
Okay, so I did 30,000 times 10% times 6/12 because it's 6 months.
Why is it 6 months?
Because it's from January to June 30th.
Okay.
January 1st to June 30th.
Almost right. Look at those dates again.
Because it says year 1 to year 2.
Right. So that's
Oh.
right.
Ouch.
So it's actually 12/12. So it would actually be 3,000. And then, because it's only, you can never go above 12. And then year 2, the additional 1,500 will be in next year. So even though it's an 18-month note, only $3,000 of the interest goes this year, 1,500 goes next year. That's what I thought. That's where I thought you were going, was you were going to do all 18 months, and then you said 1,500. I'm like, no, that would have been 4,500. So, all right. So,
That's my bad.
nope, that's all right. So, what? How are we going to record this? It's interest what?
Interest expense.
Yep. I might be losing you guys. I hope not. Interest expense.
And interest payable.
Yep. My screen just did something funny. I lost all your pictures. Are you guys still okay?
I can't see your screen anymore.
Okay. It's not good enough to share my applications, but I can still talk. So hopefully it will come back here in a second. Okay. All right. The next one gives you the number 2611 or 2610. Sorry. All right. So what would be my debit and credit?
Income tax expense and
Yep.
income tax payable.
You got it. Income tax expense and income tax payable. All right. And then the last one. I do not like that they put this problem here because it is not an adjusting entry. It happens after everything is done, and we haven't even talked about it yet, but we'll go ahead and do it. So a company declares a dividend of $7.50. The easy part is it's just $7.50. It tells you exactly how much. So you would debit $7.50, credit $7.50. The words are dividends declared and dividends payable. It is that simple. Dividends declared and dividends payable.